America go broke under President Trump? Foreign investment in the US is on the verge of a historic exodus. Bank of America has sounded the alarm. Up to $41 trillion in foreign-held US assets, the very foundation of American economic power, is at risk of fleeing. That's not a minor shakeup. It's a financial earthquake waiting to happen. Stocks, bonds, real estate, and reserves all hang in the balance. This staggering figure eclipses the entire US GDP multiple times over. What will happen if the global money spigot suddenly shuts off and the world turns its back on the US economy? By early 2025, foreign investors had already withdrawn $6.5 billion in just 1 week, while an additional $8.9 billion in investments stalled, frozen mid-air by growing uncertainty. Why this rush to exit? Political turmoil, unpredictable trade policies, soaring national debt topping $37 trillion, and powerful global players quietly selling off US assets have shattered the confidence investors once had. $41 trillion figure represents real holdings across stocks, corporate and government bonds, real estate, and reserves, roughly a third of these markets. How did the land of opportunity become a minefield for global capital? At the heart of this crisis is a growing perception that the US is no longer the stable, reliable haven it once was. President Trump's re-election in 2025 marked a turning point. His administration doubled down on tariffs, slapping import duties of 10 to 50% on goods from over 60 countries, including allies and major trade partners like China, India, the EU, and Mexico.
When you look at how the U.S. has approached with making a lot of these threats, the challenge is that the shock value of these threats continue to diminish every time a threat comes, but it isn't executed upon. So what you really need for credibility is that you have to have some clear plan, some enforceability along that discussion path as well. But of course, we can't underestimate the U.S.'s ability to continue to add more shock value in more threats going forward. So I suspect the type of leverage the U.S. has, certainly as the largest consumer market in the world, will continue to be a factor that'll cause other countries to think cautiously. My guess is we'll continue to have an extension going forward, at least until Xi and Trump have a way to meet each other one-on-one. But even after that, after they've set the tone that negotiation is still in the cards, we'll probably continue to see different levels of extension, maybe by sector, maybe by tariff categories and so forth. But the negotiation will continue extensively because the issues are so complex. As we're looking at a more volatile trade environment right now, the reshoring, the supply chain diversification will continue onwards, but it may not accelerate as fast as it used to be, primarily because the multinationals that have already diversified their supply chain probably will not need to continue to do so. I think what we may see, which is actually against the trend, is that we might start seeing some more reshoring back to China. Generally, when you're looking at reshoring, ideally you're going to be closer to where your target customer market is. But if you're looking at it purely from a cost standpoint, looking at it from the ability to create new products rapidly at a cheaper cost, then the appeal of China is going to start looking stronger over time in a world where every country is facing higher and higher tariffs and greater uncertainty.
The stated goal? To force foreign companies to build inside America and rebalance trade. Reality? Retaliatory tariffs, disrupted supply chains, higher consumer prices, and an investment environment riddled with uncertainty. In an era where capital demands certainty, how can investors bet on a market where the rules change overnight?
So, if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So 67%, I think you can, for the most part, see it. Those with good eyes, with bad eyes. We didn't want to bring, it's very windy out here. We didn't want to bring out the big charts because it had no chance of standing. Fortunately, we came armed with a little smaller chart. So it's 67%, so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything, but now we're going to charge. European Union, they're very tough, very, very tough traders. You think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%, so we're charging them essentially half. India, very, very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades, and it was only 7 years ago when I came in, we started with China charge. We took in hundreds of billions of dollars from China in tariffs, and they understood, honestly. President Xi understood. He said, look, I understand, and the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was.
The unpredictability doesn't stop at tariffs. Trump's tax policies, while lowering corporate tax rate to 21% and promoting US-based research and development, introduced clauses like Section 899 that threaten retaliatory taxes on foreign income. These moves send mixed signals, offering incentives on one hand while threatening penalties on the other. Meanwhile, the administration's massive spending spree promises trillions more in debt, shaking the confidence of those who lent America money. The federal deficit is ballooning, raising questions about America's fiscal sanity and the sustainability of its borrowing. When Washington's economic compass spins wildly, why should foreign investors hold steady? Trump's battles with key institutions exacerbate the chaos. His public attacks on the Federal Reserve and efforts to undermine its independence raise red flags about US governance. The America First doctrine signals a retreat from multilateral cooperation and a willingness to sacrifice established alliances and investor protections for domestic political gain. This volatile political backdrop makes the US look like a risky bet, prompting global investors to hedge their bets elsewhere. If the government itself appears unreliable, what hope is there for restoring faith in the financial system?